Today we're going to be talking about time is your friend and impulse is your enemy. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Friday, we've had lots of moves this week, especially in the 12 candle window, pound pairs, the pound cross pairs, gold, and today we're going to be talking about time is your friend and impulse is your enemy. Bill Lipschutz probably said it best. He's known as the Sultan of currency. He said if most traders would learn to sit on their hands 50% of the time, they would probably do a lot better in their trading. And today we're going to be reviewing the timing window and my approach based on timing alone, and a lot of the reasons why, and also just reviewing some simple steps that I remind myself that help keep me in check, but also to stay on track and not enter into the market when there's low probability opportunities where I'm going to possibly get caught inside, as many of you have probably found out, and lots of people have emailed me and commented on that themselves about certain hours when the market will lull you into false moves before drawing back inside of the box, trapping you there, sitting, waiting until the timings kick in again just prior to the 12 candle window and we see a stop hunt. Possibly you're on the right side or the wrong side, but sometimes it's a 50-50 game, and as I talked about in one of my previous videos, I'm looking for 90-10 possibilities rather than 50-50 inside of the box. And again, for those of you who have asked, the link for the Pepperstone webinar replay is down below. Thank you again for all the great feedback, comments, and questions. I know a lot of traders have really been able to change some of their approach to trading and see some very good results, some positive, profitable weeks after a lot of struggle just by incorporating a couple of tidbits that they've picked up from me. And again, I'm passing on information that I've learned the hard way in live time, piecing together lots of different ideas and strategies that I've picked up from lots of other traders. Just to reiterate, one of the questions was the three pairs again that I mainly have narrowed it down to. I still look at all the pound crosses every single day in terms of how they've set up, but I'm mainly trading the pound USD, pound Aussie, and gold. And as I mentioned, gold has just had some huge moves. It adheres to the timings, and again, understanding that gold USD is a forex pair, it's a hedge against the US dollar. So again, it's very similar. It has a tight spread, but lots of volatility. And again, just understanding that it follows the same numbers, timings, high and low of the day, some simple stuff, and again, just looking for some simple setups. Today we're going to just review one of the things I look for each and every day. We saw some great first bar trades yesterday, right at the beginning of Asia and London, on pound Aussie and gold, and we'll talk about that again today. We'll look at those videos. So the first thing I say is, what time is it? Because if I'm not around the high probability times, I know that I can get trapped into poor quality trade setups or false moves before the session is ready to move, or lock in a high or lock in a low, or get caught into a stop hunt, which again is okay as long as you know to go to break even or to take money off the table. The next thing we want to be asking ourselves prior to each session is, where are the profitable trades at? Where are the stops at? Where are the retail traders' stops? If you were short the market, where would your stop have been in the last session? If you were long the market, where would your stop be in that last session? Where is the money? Because the market is going to head there, and again, that first hour can often dictate where they're going to go, to the high or to the low, or back inside of the range, stop hunting a move from the previous session if the market's had a 50 pip move. So where's the high and the low? Well, that's obvious. We want to know where the high and the low of the day are once they've set it in the Asian session. If they've extended it out, well, then we know we have a low and a high, and wherever they're extending that range, they may not be done there yet. They may continue to go higher or to go lower in that next session. Where's my 50 pip box? So again, we talk about double zeros and 50s. The market can extend out to a quarter range on a stop hunt extension before locking that in and reversing and shifting back in that 50 pip box. or extending it into a quarter range and pulling back into the round numbers to continue a move for 50 or 100 pips if it's 00 to 00. And the first bar in that first hour will often tell us if it's going to be a first hour move, a breakout pullback continuation or a stop hunt, or if we're going to get a second hour trade. So if the market just continues to move in that first hour, we know that we're now potentially in a range extension where they're going to put in a high or a low in that London session. And being aware that that high and low may also be for a continuation move, a measured move in the other direction with the trend. So just to review our timings window. Asia, 8 to 11 p.m. New York Eastern Standard Time. In that 3-hour window, they will often set a high and a low. Sometimes in that pre-market hour, they may either have gone to a previous US session high to lock in the high of the day, or they may go up to a high in that hour and then put a high or low in place. But that pre-market hour will often be a stop hunt or a move into the open for the move back to the high or down to the low, whatever that may be. But once we have that high and low in place, and again, unless they extend that out, they'll lock it back inside on most days and go into consolidation. And in that next 2 to 5 a.m. window, 1 o'clock time, that pre-market hour, that pre-12 candle window will often be the beginning of a stop hunt or locking in a level before they head into that first hour. Now, we talked about first hour, first bar trades. We'll often look for either a pin hammer for longs or a bear pin hammer for shorts if they've already locked in a high or a low. And then the next thing we want to be looking at is, are we at round numbers? Are we at 50s, double zeros? If we're at quarters, if we're at a quarter level, then this just may be a 25 pip move outside of the Asian range. But if we're at 50s and double zeros, we can see that market move 25 and possibly 50, especially if there's a level above or below Asia where there are stops, or from a previous session in the US or London the previous day, or again a previous day's high or low. So if we've triggered one of those levels, we sometimes see that in Asia early on. They'll go up and hit a level or down and hit a previous day's level right off the bat before going into consolidation and resetting the high and low as we head into that Asian range. Same thing applies for New York. As we head into that New York pre-hours 12 candle window, we will often see a stop hunt to the high or to the low from the London or Asian session, or back inside before they head to the high or low in that first hour, which again we talk about can often be the trap and the stop hunt combined. But the other thing to take into consideration is again the round numbers. When we head into each session, where are our major round numbers, 50s and zeros? If we're outside of those, we could be in a 25 pip box for the reversal or for the continuation, depending on how that market has already set up and where we're at in relation to the previous day's highs and lows in that weekly template. The biggest thing I'm trying to convey to you today is that timing and time are your friend. Impulse is your enemy. There are other trade setups in and around those time frames, but in a lot of majority of those cases, they can be 50-50, where you get caught into false moves and the market bundles that range back up inside and holds it there until they're ready to move it in the next session. So you can be caught into what looks like potentially a good move, but then all of a sudden it stalls out, or it doesn't go anywhere, or it stops to have any momentum, or it reverses quickly against you and stays consolidated. It doesn't hit your stop, but it doesn't move in your favor, and you're sitting there in the abyss for the next few hours. The whole purpose of me approaching the market around these timings is that there's a high probability that there will be a fast 25 to 50 pip move in that first window of time to either hit stops, or to break out and continue a move, or to reverse a market and go back in the other direction. And the most important thing is, where is the money? because that will help you have clarity in terms of the direction and understanding that if you are caught in the wrong direction, why it's so important to have that tight stop and be open to looking at the market for an opportunity in the other direction if you've missed that, because once they're going to go for the money, as you know, they move very quickly. So hopefully you got some value from today's video, traders. Time is your friend, impulse is your enemy. The whole point of me sticking to a very regimented routine, timing-wise, and those simple steps, high of the day, low of the day timings, round numbers, engulfments, pin hammers, a 1-bar stop, and a 50 pip target, is because I can duplicate that day in and day out. You need to hardwire yourself for whatever your process is to sticking to those rules. That's what will protect you. So it's not so much that you're missing out on trades or you're going to have other trade opportunities and the market moves without you. It's about consistency over the long term, ensuring that you're not going to engage in sabotaging behavior and having a strict trading process that you can adhere to, that's simple, that you can duplicate day in and day out. If you can do that, that means you can duplicate your results. The market's going to change, but your process will help you adapt day in and day out to the opportunities when they present. Let's take a look at some charts. Again, thank you for all the great comments and feedback. Thank you for hitting the like button, and thank you for turning on notifications. I got a ton of emails. I really appreciate it. I just love hearing that people are doing better. My big objective is to help people achieve their goals through trading, and by doing that and just staying focused day in and day out on my own trading plan, this helps me to help others. So stay disciplined, traders, stay focused, crystallize exactly what you need to do, and just do it. Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Continuing our discussion, time is your friend and impulse is your enemy. And just reinforcing the importance of timings and just the simple concepts, the high and the low of the day, the timings of the 12 candle window, the round numbers, and specifically the understanding of them going after the money. So creating a high and a low, trapping traders inside of a high and a low, making the move back towards the extreme to hit the stops and either break out and continue for a trend trade or for reversing the market and heading back to the other side. You know, this is just basic common sense, and when you think back, and look at this in the big context of things, you understand the psychology. Again, I keep harping on the fact that it's us against them. They're there to take our money. They being the smart money, the big money, the money that moves the market, whether there's coercion, whatever, algorithms, it's pretty much obvious there is algorithm-based trading that's happening. Specifically, the timings are very specific. The patterning is very specific. But also just the common sense. This isn't my theory. This isn't, my idea. I've just pieced together a lot of little things in my learning from a lot of different people and a lot of just simple concepts that are actually have always been there from the beginning of the market. Edwards and McGee, Schaubacher, Wyckoff. This stuff's, over 100 years old. Jesse Livermore talked about very similar things. There's nothing new under the sun. It's always us against them, and them is the other side, whoever that is, the bulls and the bears, whatever you want to call it, but the big money moves the market, and they're going after our stops. If you want to sit inside of this stuff for hours on end hoping to scalp pips, that's your choice. My objective, as I keep reiterating and trying to share with everybody, is identifying the highest probability time frames of when the market is going to move, what the thesis can be. Are they going to be moving it to the high or to the low in a stop hunt, or are they already there and they're going to reverse the market? Is that initial burst a stop hunt for a reversal trade? All those little things. That coming back to where we're at in that weekly template, the type of setup that it is. We're going to walk through the British pound. We'll look at gold as well. But just simple common sense every day, just looking at what's happened in the previous session. Have they already done a stop hunt? We head into Friday, Monday, again, just the rollover from Friday to Monday. We have a lower high in the U.S. session, but most importantly, we know that traders have shorted the market in that U.S. session. So in Asia, right away, they go back up and hit stops. They might not necessarily go all the way through the highs. And there's a reason for that. That potentially may entice traders back shorting the market, thinking this is going to roll over again. So this gap down, whenever there's a gap, Al Brooks taught me this, whenever we get a gap in the open, that's the same as a bear candle down. The gap was down, that's a bear candle. So that ends up becoming a peak formation low. That's a peak formation low. They come right back up and hit the stops on the lower level shorts. They pull it back in after going up and getting traders potentially at break even. They pull it back in 3 pushes. They put a low in place in that 3-hour 12 candle window. They go 2 pushes into the low and give us our lower geometrical structure, which is our W at the low of the day of the Asian range. They consolidate and give us a pin hammer inside. Now the thesis again is, where are they going? Well, if there's stops up top and the previous day's high is up there, that pin hammer in the 3rd candle. Now, if this is to break and go through, you've got a 1-bar stop, and on an hourly chart, this 4-bar pattern is a massive open drive bull candle. So just little things, constantly thinking. I talk about in that rotation in your mind, first and last candle. Well, we're in the 3rd candle, but we've got our pin hammer. So that's obviously has the possibility, and we're going to look at another example yesterday on gold from Friday. There's same situation, 3rd bar engulfment, massive bull pin on the 1 hour, but it broke out for 50 pip move. So they work the low, they put a low in place, and they work at 1 push, 2 push engulfment, 3 pushes down altogether, sideways consolidation, pin hammer for the move right at the beginning of the 12 candle window for 50 plus pips. Now, again, they go up and they put a high in place. They get traders shorting the market. Bang, they hit the high again. Now this is in the gap time. They come down and get traders in the pre-market, and just in heading into the equities hour. There may have been some news release or something. I'm not sure what caused that vertical candle, but I do know this. We're at the high of the week, and we have 3 pushes into a peak formation. So even though it's the first day of the week, it's the high of the week, and we have a 3-push pattern culminating in a engulfment, 2-bar engulfment, reversal off the numbers back down inside of the range. So there's our high of the week and our low of the week. But again, the simple concept, we come to the chart at the 12 candle window. There's a high, there's our low. They hit the low, they hit the high. Whenever you get a candle like this, people say, well, how did you trade that? Well, you're not. That's the whole thing. You're not trading this. Short bear pin hammer, short engulfment. Whenever you're forced to chase something at the high or low of the range, you can guarantee that you're the one being trapped. You will always have the best fills either at the high or the low, or inside on the 3rd push for the move back down after a 1, 2, 3. So we're inside of the range, and again, just going into the rollover. Asia, high and low. They first hour puts a new peak formation in place. They go up and hit that in Asia in the equities hour, confirming this is our trading range. They hit the stops, they expand the range slightly, but they stay inside of that consolidation. So we have a sideways market, which eventually breaks out. So again, my whole thinking is always, I never want to be in here. Look at how long if you're in here long or short, even if it's moving in your direction, like you're not really going anywhere. You're here for an hour and you can't even go to break even probably. They're just whipping back and forth. I want to get into the market when it's going to move. And if I'm sitting in a trade and it's not moving, then I'm either trading outside of the time frame that I should be in terms of the gap times, or I'm just I'm not in the right trade. I'm in early or I'm in late, one of the two. And again, when these go, they break out 1, 2, 3. So again, first hour, no pin hammer. We're inside of the trading range. London breaks out 1, 2. Second candle down 25 pips, a little bull hammer. And again, I keep reinforcing this. You don't know. You never know. But you have a 1-bar stop. But I understand the importance of timing, the timing cycle. We're in the 2nd hour, the equities hour. We're down low on that first open drive candle at the numbers with a little bullpen hammer. Typically, that range the first 2 candles of a trading session will form 50% of the time the high and low for the session. Within the hour, 75% of the time that will form the 2 extremes for that trading session, as again we talked about in market profile. So we get a 1, 2, 3 down. The equities candle, second candle of the hour, bang, 50 pips up. And you know what? I hardwired myself to hitting these trades and just putting my bar in and my stop and my target and walking away. They might have held this here for 10 minutes before they moved it. I don't know in retrospect. But point being is that if you're sitting there staring at the screen, you will, which is partly their approach. They want to shake you out of the market. They want you to get out. They want you to get scared out. You don't even have to use the 1 bar stop. You can use a 20 pip stop. So if you're filled here at 20, 25, 27 with the spread, the low of this candle is at 18, you can still put a 15 pip stop in there or a 20 pip stop. Walk away. If it goes 20 more pips, it probably is wrong. If it's wrong, so what? Move on to the next trade. You're still targeting asymmetrical risk reward. You took a trade, you put your stop in place, you put your target in place, you walk away. That's trading. That's all it is. You sitting at the screen, worrying and stressing and wondering, if you should get in or shouldn't get in. That's why people can backtest all day long, all they want. But in live time, they will never get the results consistently that they're after. They'll say it doesn't work, and they'll system jump, and they'll go on to the next system, and they will do the exact same thing. They'll get an algorithmic system, and they'll still manually stuff it up. So keep it simple. Hardwire yourself. Say, today when I get the right trade, I'm just going to, even if you start off with a micro lot, put a micro lot in. Practice the art of perfecting your process. Master your process. This is a great example. We went over this the other day. We got our high and our low. They came and hit the low. 1, 2, 3, first hour, engulfment, pin hammer, sideways, boom, open drive candle. But they go sideways for 4 candles without the follow through. So they get traders holding on to this before they come back. But I've mentioned before, if the market spends half an hour at a level without follow through, I'll just take whatever I've got. And I did that yesterday, knowing that the market potentially still had more movement in it, but I was happy it was Friday. I took the 40 pips, and I'm okay with that because I had other things to do. The market did what it was going to do, and I didn't want to hold on to it and hope that it went another 10. I just took the 40 and said thank you. Move on. Monday's a new day. So we go into the next day. Who's in the money? Oh, wrong bar. Who's in the money? Where are the stops? So we talked again about the day zero, the large rectangle, the consolidation, and the breakout pullback for the continuation trade. And, I struggle sometimes with trend trades. But again, you hardwire yourself to know after going through trade after trade after trade, when something looks like a duck and walks like a duck, smells like a duck, talks like a duck, if they talk, Daffy Duck. They formed a smaller geometrical rectangle inside of the low of the day. They went straight away in Asia through to the high of the day. This is the dead giveaway, the consolidation after a move off the bottom or the top, the consolidation, and the continuation right away in Asia. They go up, they hit the blue tracer, they take out stops. They also trigger breakout orders, but they pull back and go right into the open with that little breakout pullback geometrical structure, which again is just a smaller pattern within a pattern, aka Peter Brandt, for the continuation trade. And again, straight away, I just sit and think measured move. So minimum is a full expansion, and a strong trend day, I'm looking at a minimum of 2 expansions. This was a really strong day, so we're looking at a 3rd expansion. I had somebody say to me once, "Well, you can't do a measured move. That's predicting. You don't know where the market's going." We're talking about once you're in the trade. Once you're in the trade, this is what I do. I put my measuring tool on there, and it's not Fibonacci. I mentioned this before. People have asked me where they can get it. It's just the Fibonacci tool that I've taken the numbers and just changed it to 100% expansions. And that, again, is just measured moves. All this stuff about, fib levels and all these things and pivot points, I'm sure they work. But look, I'm just looking at 25 pip boxes. As I said in the last video, I'm keeping this as simple as possible. Tomorrow I want to use 25 pip boxes. The day after, I want to use 25 pip boxes. I don't want to guess if it's a 6.123 reversal or a 0.34, 3817, something like that. I don't really care. I'm just going to trade the box in the 12 candle window. I'm going to put a target in place, a 1-bar stop, and I'm walking away. So again, each session, highs and lows. They break through the high, pull it back, hit it again, pull it back, and in the U.S. Open, they break out through that high. So again, pattern within the pattern. We got a smaller geometrical rectangle prior to the window within the pattern. After a strong breakout, this is an always in day. So you're just looking for simple stuff. No matter what you think, if you're getting in the market, and unless you're chasing a move, if I'm getting in at the beginning anywhere, and I'm thinking that this is what it's going to do, I'm just going to put a stop in and a target and walk away. And you will be amazed how many times you sitting at the screen without doing that, watching it, and it'll take off and you'll go, I knew it was going to go, I should have got in. So I'm just looking to keep on track with my trading objectives. That's my plan. Put my trade in, put my target in, put my stop in. The most important thing you can do is have a 1-bar stop or whatever your risk is on that trade. If you can do that and your profit to loss ratio is 3 on average, 3-4 to 1 over time, you just, again, you hardwire yourself. You're a master of your craft. Hit the trade, put your stop in, put your profit target in, walk away. Or, stay at the screen, move your stop to break even, whatever you're going to do. But keep it simple. If you keep it simple, you can duplicate that. And if you can duplicate it, you can reproduce it. And everything that I have tried to eliminate from my trading were all the things that were reproducible, analysis paralysis, all the stuff that interferes with real consistency. So I put a stop in, I put a target in, I hit the trade, and that's all I do. So again, we just, high and low, they broke out in the market, 1-bar stop. This is why sometimes, right here, whenever you get in, nobody gets a free lunch. And this is often where traders get shaken out. There's always a retest, always. I knew a very successful trader in Australia here who traded mainly shares. He would have 3 entries. He would trade the initial breakout trade. He would trade the pullback trade, and he would trade the follow-through trade as it retested and broke through the high. And then that was his full commitment to the trade. He would have 1, 2, and 3, and he would move his stops after they cleared one measured move. So everybody has their own preference in terms of how they want to manage their trade and manage their risk. My trade management is based on knowing that they will come back often within the move. If it's a creeping move, a creeping trend rather than an aggressive fast move, they will come back inside of that as a creeping trend. And algorithmically, I know they've got that calculated that they can come back just enough to get people who are in the market on those moves at break even. So again, I'm quite happy to hold on to my trade until it clears a new level. So either a new quarterly level, or if we have a break through a level. So an example here, if we were in this trade and the market broke to new highs, we would definitely be at break even. If it's cleared 50 pips, we'd be at break even if we're not already taken out. But in this initial move, beginning of the market, they break out. We can expect a retest. On the follow through, I would be at break even. Again, these trades, if they're my thesis is that if they're strong, fast moves, they should not come back. So if I'm in the trade and I'm up 25 pips, and it's a fast-moving market, I'm moving my stop to break even. But again, each session coming back and saying, where is the money? Timing and staying out of the market, not going back and giving the money back after you've made it. So you make 50 pips, you're in your session time, you're out with 50 here, and this is where they trap traders again inside the market. If you get your 50, I'm gone. I'll come back later. If you're looking at the market, strong trend, get back in. So simple stuff, and sometimes simple is simple not to do. And I know there's so many tempting things, which is why I usually walk away and get away from the screen, go for a run, go down to the beach, whatever that may be. It's just constantly there, and I know that once the market has moved, it's set its high and low. We're talking about a market now that's possibly congesting. So again, that first hour, 1, 2, 3 down into the London Open, hitting the stops. Pin hammer, getting traders going long possibly. Stop hunt back to the high of the day. Second candle equities hour, taking traders back up into the extreme, chasing the move, thinking it's going to be going back to previous day's high. Third candle, bear pin hammer. And there's our anchor point at the London Open for a measured move down. So 1, 2, 3 down into the London Open. When London opens down here and they go up and hit the stops and reverse on that third candle, fourth candle's inside. We know that London hour now is inside the range. They've given us an anchor point that's got traders chasing it back to the top, but they've hit the stops on both sides. We're inside of the peak formation. Keep saying don't counter trend the peak formation high. We're looking for shorts. Market falls over. They go up and do the same thing in the U.S. Open. First hour, sideways, and then 1, 2, 3 to the high into the equities hour, getting traders to chase it into the high of the session, chasing the false move before coming back down to the low of the day. Where is the money? Timing. Time is your friend. Impulse is your enemy. So again, all this stuff inside, scalping some pips possibly, or else getting caught. They go up, but not far enough for you to get too much. They come back. They pin into these moves to make sure that if you are in the market, that you're getting stopped out at break even, or you're under heat if you're in the wrong direction. And then they come back and get traders who are chasing the move in the gap time. So chasing the move, thinking it's going down to follow through or hit the stops, and they go sideways for 3 bars, and then bang, 1, 2, 3 to the high of the day. Was talking to a couple traders this week, and again, just reinforcing basics, high and low timings, round numbers, 50 pip boxes. If we're heading into the session, where's our round numbers? Okay, there's 50 and there's double zeros. They put a low of the day in place. There's the high of the day. Okay, there's the high of the last swing sell from the U.S. session. So we're in a down move. We got a creeping trend down with lower highs. Asia gives us a lower high. So again, U.S. session is the high. Lower highs, follows through on that breakthrough, the U.S. session low, pulls back, goes into consolidation before dropping down again. And again, you'll notice the 1, 2, 3 in the initial move down, sideways. Then the continuation back down. So we got our low of the day, and they come down in the gap time. They're working the low of the day. They pull it back, and there's your 1, 2, 3 again, sideways, bull candle, bear pin. So there's our first hour, push down, bull pin, follow through on the last candle of the first hour, small bear candle, weak follow through, and then bang, our engulfment candle on the London Open. Right at the London Open at the low of the day on the third push to the low. We got lower highs, and we have money sitting up above these lower highs. So 1 bar stop, low of the day, London Open, 50 pips straight up. 4 bars, 50 pips. So here's 8 hours, 25 pips roughly, and there's 1 hour, 50. Timing is everything. And my favorite thing on a Friday is getting a trade like this, knowing, and by the way, I did not take this, but Trader David, who's out there, shared me a screenshot of this trade that he took, and a brilliant trade. Congratulations. This is a better trade than I had on gold, and I'm going to go through that in a second. But whenever you get a trade like this on a Friday, I'm always thinking Friday New York reversal, because they 90% of the time will finish the week making sure that this guy or whoever's in the money gets hit, at least a break even. And they came back earlier than I expected in 3 pushes, consolidation, but the gift was the 1, 2, 3 up to the high of the day and the inside bar. And then you get the engulfment and the falling market into the equities hour open for the 50 pip move back down. So 25 up at least, if not more. If you were in this move up, you want to be at break even once they hit the highs. Consolidation at the double zeros and then the inside bar. and the fall over in the last candle. And the first candle of the equity starts to move back down to the low for the 50 pip move down into the close of the week. So Friday reversal is whenever you get a strong move in London, unless there's news like payrolls or something else, but even often with payrolls, they'll see the reversal come back and hit that trade. But where is the money? So somebody went along, they had stops down here, there was stops from the London guy. They get people shorting this market in 3 pushes, thinking they're going to go through the low of the day. The timing window kicks in, they go into consolidation, and bang, bang, straight to the top, hit the stops, disappointing all these traders who are short. Remember the golden rule. The objective of the market is to make as many people as possible disappointed. So whatever seems obvious is usually the trade that will fail. 1 push down, 2 pushes down, 3 pushes down, reversal, engulfment, straight through the high, and then 50 pips down. So when you get really good, there's 25 up and 50 down. If you're really, really good, there's 25 plus up and almost 75 down. So I'm still working on that. But again, the high and the low, timing is your friend. We'll take a look at gold. So my trade on gold yesterday, as I mentioned to David, similar setup. Now I just sort of seemed a bit more fixated on gold. I noticed that they had traded down in Asia. They put a middle structure in place and the pin hammer for the move back up to the high of the day. But they were moving back into the peak formation from Thursday, which led me to believe that they were working the low. They gave the W, then we had the creeper down, 1 push, 2 push, 3 pushes down, and the engulfment, third candle of the first hour. It moved right away straight up in the last candle of the first hour to hit the stops, and then went into consolidation, and then the explosive move out of the box. And this is where the first candle of the third hour, the second doji pin, is where I exited the trade for 40 pips. As I mentioned, I just had stuff to do and I didn't want to hold on, but my measured move on that chart was for at least the 50 pips plus. So, but again, I was happy. On a Friday, one of the things I always strive for is to have flawless execution on my trades so that I don't go into the weekend having done anything stupid or half-hearted, haphazardly. I always like to finish the week and the day, for the most part every day, but the week on as strong a note as possible. I mean, just focus on executing your trade setup. If I get stopped out, so be it. If I take a loss, so be it. As long as I did everything right. And that's the most important thing, especially at the end of the week. You want to finish on a strong note. You want to have a really positive headspace heading into the weekend. You don't want to do something stupid, especially on a Friday night. Take a beating. Engage in impulsive, irrational, emotional behavior, and then all weekend beat yourself up, be up and down, elated, depressed, study, go back to work on Monday and try to figure it out and how to do it better. Just keep it simple. Focus on executing every single trade, one at a time, to the best of your ability. Win, lose, or draw. Learn from it. What did you do well? What could you have done better? Move on to the next trade. Now, I actually liked David's trade in London on the pound better than my gold trade, even though they're, did the same thing. But I like the gold trade better in New York than the pound one. So we had the retest of the high and 3 pushes up to the high, a 1, 2, 3, and then the engulfment pin hammer on the last candle of the first hour, and then the little bear pin at the open of the equities hour at the double zeros for a 100 pip move down. And as I mentioned, it went further than that. It went through to the low of the week, pinned it, pulled it right back, and then finished the week into consolidation. So again, coming back to the beginning of that session, highs and lows, where is the money? They kept traders inside of that high from the U.S. session, but they were jamming them in down low. The first move was down. They pulled it back. They worked into it again. A third time, a little bear candle, no follow-through, engulfment for the stop hunt to the high of the day, and then 3 pushes down into the low, a 1, 2, 3, engulfment, open drive, continuation for the 50 pip move. So there's nothing secretive. There's no magic formula. Traders, high and low, there's stops above there. The market will go back. And again, we had an example on Thursday on gold where we went down They put a low of the day in place, and they went and did the rounded bottom pattern just in the gap time. They hit the highs of that traders who have shorted this market. It came down 1, 2, 3, engulfed. The first candle of the Europe 12 candle window was a bear pin, but it's a 1, 2, 3 down. The break of this candle is at numbers. It went up 50 pips, targeting traders who are in profit. Who's in the money? This guy shorted the market, possibly in Asia, a little bear pin at the equities open, the doji. Okay, so the first guy they're looking for possibly is this guy, and the move was up, so follow the money. And then the next obvious move once they've hit the stops, so they get the engulfment, they come down 1 push, 2 pushes, a third push and roll it over. We got stops down below the low of Asia, little bear pin in the gap time. So again, an example of where there are trades in the gap time and some very good trades. But just as we head into the 12 candle window, we get the inside bar after the drop down. So again, where's the money? And bang, straight fast forward move through. In that first hour, when we get a big candle, the first thing I do is I redraw my highs and lows. They go into consolidation and they give us pins. So there's my high and there's my low. And that's all I do. Whether it's an announcement, whether it's just a blow-off candle, as soon as it goes into consolidation, I redraw my highs and lows and I go back to work. We get an engulfment. If traders aren't shorting on a shorter time frame up in the top part, we get an engulfment, bear pin hammer, 50 pip move down. As again, this gold can move. When it moves, it can have some very big moves. So there are plenty of trades. Keep it simple. Again, 1 bar stop. I want to be wrong as soon as possible. And there's no better feeling than being stopped out with 1 bar. And the only other bad side of that is if you've had too much leverage on a poor quality setup, meaning that you've taken a trade setup outside of your trading plan, over leveraged. Even if a 1 bar stop is there, it's still too big in terms of size. So stick to your risk management. 1 bar stop, 50 pip target, 40 pip target, whatever that is. When it moves 25 and it's moving fast, again, these trades, when they're stop hunts, they move fast and they're done quickly. So, 3-4 bars, you should be ideally, hopefully be at break even and even moving closer to your profit target. So hopefully you got some value from today's video, traders. Thank you. Tons of traders have sent me screenshots, some huge results. I mean, honestly, some great trades. And again, it's really simple. I just focus on hitting those trades and hardwiring myself. You make mistakes, you learn from them, you keep getting better. You stand back. Time is your friend. Timing is everything in this game. The algorithms work on timing. The market moves on timing. Everything else in between potentially will trap you into sitting in these low probability opportunities. And again, more stress. So I like little stress. I like tight risk management. I like asymmetrical risk reward. And I want to stay in the game long term and get better and better at it and bigger. So have a great trading session, traders. A great weekend, that is. And again, thank you for the great feedback. And keep the comments coming. Let's you and I get better together. Hi,
Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.